Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me for a second time David McAlvany. He's the president of the McAlvany Financial Companies, McAlvany Wealth Management, and ICA. It's a 36-year-old precious metals brokerage firm, and David, his full bio can be read at our page at the Voice America Business channel, so go there if you'd like to learn more about David, or go to McAlvany.com, better yet, the place to go to in any event to learn not only more about David, but more about what his firm does, and also to pick up on some excellent commentary that he provides on a weekly basis, and I understand probably another one will be coming out this evening. So thanks for joining me again, David. It's really good to talk to you.
Jay, it's great to be with you again. Time flies when you're having fun. I think we need to update our bio with you. We're 43 years in the business and still enjoying it.
Oh, okay. Well, it hasn't been. All right. Well, my apologies. Well, thanks for pointing that out. 43 years now. More credibility under your belt, no doubt, because I know the business was started by your father many years ago. I'm more your father's age, so I've been around probably longer than you have in a way. So, but in any event, thank you for being with us. And before we get started, I just real quickly, if you could just tell our listeners what you do provide. You do provide wealth management services, I guess, and you sell precious metals. Anything else?
Yeah, the combination is kind of a nice hand-in-glove fit. We are, on the one hand, your defensive coordinator from a financial standpoint. We look at precious metals as a form of insurance for your financial resources. And so from a defensive posture, that's always, we go back to 1972 when we opened our doors. One of the first to be in the gold bullion business, actually a couple of years before it was legal, finding a cute little loophole. I'd be happy to tell you about sometime. The money management business is more of the offensive coordinator for our clients, if you will, looking at stocks, bonds, foreign currencies, commodities, et cetera. We manage all of that on a discretionary basis in separately managed accounts. And, the other thing that we spend a lot of time doing, as you mentioned, the commentary is a way for us to keep in touch with folks and have them know our thoughts on a weekly basis, what's happening in the markets. Education's a big piece for us. So just finished a book and are working on a homeschool curriculum on economics, investment, and finance. So education is certainly front and center in everything that we do.
Wow. Does that new book have to do with the homeschooling economic curriculum?
No, it's different. It's called Intentional Families, Reverse Engineering a Legacy from End to Beginning. And it looks at all the aspects of the legacy that we desire to leave for future generations. Clearly, at a high-level view, we can say that the legacy we're leaving, whether it's the $18.4 trillion in real-time debt or the long-term unfunded liabilities of $210 trillion, it's not the kind of legacy that we would on the surface choose, but that is nevertheless what we're leaving. This is more of a personal look at what we as individuals choose, the way we organize our home life, and the resources that we manage, whether it's the intellectual capital, the emotional capital, the spiritual capital, all of the other elements that go into the legacy that we leave. And I make the case that legacy is not something that you actually do leave. It's something that you're creating right here, right now, daily basis.
Absolutely. Well, I really look forward to that book, and I hope you can come on and tell us more about it once it's out. How soon will it be out?
Hardback will be out in 6 weeks.
Oh, it sounds like something that would fit very, very well for this show. So I hope you can, when you're ready to sell that book, you'll come on and talk more in depth about it. Well, speaking of wealth management, can you tell our listeners what you are doing right now for your clients? I mean, I heard your podcast, your weekly commentary, and I would just strongly suggest to my listeners that they go to McAlvany.com and listen to that weekly podcast that's put out there. It's about an hour long, isn't it, David?
Yeah, sometimes it's 30, 40 minutes. If we get long, then there's a lot to talk about. As there is in the markets today, it'll stretch to an hour. What are we doing? We're focusing on liquidity. We're focusing on moving towards market and market neutral position. And, there's a lot of ways to lose money today, not very many to make it where risk and reward are in balance. So we do think that the opportunities are on the horizon, and liquidity is, in terms of its optionality, is to be valued. Market neutral positions, that is to say, if you have an equity position, being hedged, we have been for several months, and even a net short position would be appropriate at this juncture.
Well, I did hear your comments about Louise Yamada. She's someone that I have a very, very high regard for, have met her personally on a number of occasions and find her to be a very genuine, honest person, as honest as anybody I've seen in this business, I would dare say. At least that's my judgment. You noted that she's turned bearish, and she talked about it on Tom Keene and on Bloomberg one morning. Teresa and I were having breakfast. We almost fell off our chairs, but no, not really, because we've known Louise. But what are your thoughts? And also, I'd like to ask you about another comment that you made on your show having to do with how the market sentiment is changing. Whereas at one time, good news was good news and bad news was good news. Now, almost no news seems to be good news, although I would mention that today the equity market is up big time. It's up about 250 points on the Dow. But so what are your thoughts about Louise Yamada and her forecast, as well as the equity markets in general? Why do you think this sentiment has changed?
Yeah, 15, 20 years ago, that's when I first ran into Louise Yamada and Alan Shaw at Smith Barney. And what I at first thought was sort of voodoo, which is, the art and craft of chart watching and understanding, became something that I understood later as very prescient and very helpful for acknowledging and marking market trend changes. So Alan Shaw and Louise Yamada, I consider to be then and now two of the best in the business. And her call for, on a monthly basis, looking at monthly indicators, us heading into a bear market, I think is significant. It's considerable. It's not so much the issue of a cyclical trend as a long-term secular trend. Is that a 6-month downturn? Well, it could be at least that. But a long-term secular trend can last many years as well. I guess the issue in play is central bank resolve, because we've had the opportunity going back to 2011, 12, and 13 to trip over into a formal recession, and central bank intervention pulled us right out. And the indications that we had, certainly the Economic Cycles Research Institute had suggested all of those years we were heading into recession. And lo and behold, those were neutralized by massive, massive central bank intervention. So do we see that again? Perhaps. But something that has changed, which you suggested, and which I did in the weekly commentary last week, market sentiment has changed. Market sentiment has changed. The average investor feels differently.
He certainly does feel differently, but why should he? I mean, it seems to me that we've had this lots and lots of money. I mean, there's been a put given in the market, so as soon as things start to fall, the equity market starts to spin out of control. In comes a huge amount of new buying, a new amount of money into the system, probably some plunge protection team action at the right times to keep things from getting out of hand too far on the downside. So why wouldn't you just sort of assume? I mean, I've been on the short side of this market far too long. I've been hurt very badly by not playing the game along with the bulls. And I'm thinking now, what a fool I've been. Perhaps I should just sign up for Mr. Krugman and the rest of these Keynesians.
Well, what we find in talking with people directly is that they're looking back at 2000 and 2008 and saying, twice this has happened to me. I've lost tremendous value being long equities, and I may be above my original starting point from 15 years ago, but only marginally. And I don't want it to happen a third time. The sense is that something's not right. As we talk to folks across the country and around the world, number one, they don't trust the data. The information that's being provided from your major wirehouse firms, they look as very one-sided and skewed. And so their sense is that they're being misinformed on the one hand, something's not right on the other, and with that in mind, sort of anticipating the next shoe dropping, they don't want to be the third time the fool, having ignored the signs and signals.
David, the way I look at this, and you alluded to it or talked about it directly, actually, on your last commentary, about how central banks have just, completely not allowed the markets to work, not allowed the excesses to be wrung out of the system by the market action. To me, it's a little bit like, if you take a beach ball and push it under the water, it wants to come back up to the surface, right? But and if you think you can let it up slowly, it's kind of tricky, isn't it? It's a little bit tricky. You let it up a little bit, and then it gets out of your hands and just explodes right out of the air. the Fed is contemplating a quarter point interest rate rise, and as you and I have talked about before we went on the air, that's just a little bit. That's not much of it. I mean, it's just the rates are so minuscule. The rate levels are so ridiculously low right now, so far out of touch with free markets, I'm quite convinced. So can they do it easily, though? Can they let the gas out? Can they let the beach ball come out easily, David, or something might get out of hand?
Well, it's going back to the ideas originally written up by a famous economist from Sweden, Knut Wicksell. He, in the 1860s and 70s, made the case that if you keep interest rates too low for too long, ultimately they go much higher than you would want them to. And it is like that beach ball that you mentioned. It tends to breach the surface of the water, and it finds equilibrium ultimately, but only after blowing past it initially. So I think the reality is they'll do everything that they can to sit on interest rates, and they're kind of stuck. They've created a massive amount of liquidity on the one hand, which they've given to banks to lend out. Now they realize that there's too much liquidity in the system, and they need to take it out of the system gingerly. The New York Times article from the 13th would indicate that they're going to be paid tens of billions of dollars not to lend. The Fed will pay tens of billions of dollars for banks not to lend to the general public and to keep those excess reserves still deposited with the Fed. Does that mean that they're going to increase interest rates there as well, increase the interest component to those excess reserves of depository institutions? Perhaps. But the other issue is, where will they take interest rates? 25 basis point interest rate increase means that we're still, in real terms, factoring in the CPI, standard measure of inflation, still negative in real terms by 125 basis points.
Yeah.
So we remain incredibly accommodative. And an accommodative level we haven't seen, really, frankly, in the history of the world. 7 years at zero rates, and in this case, factoring in inflation, negative rates, that's extraordinary. That's extraordinary.
And at the same time, of course, they want to keep the equity markets up. And you did refer to the plunge protection team on your last podcast. Wall Street is quick to denounce China for manipulating its stock market, and yet, as you pointed out, we're doing much the same thing through the Fed, but not directly through the Fed. Could you talk about that a little bit, David?
Well, sure. I mean, the President's Working Group on Financial Markets is sort of the best and the brightest from the CFTC, the SEC, your major regulators, and your major Wall Street firms. And when the markets get dicey, smoothing that volatility is very critical to making sure that mom and pop with a stock portfolio don't jump ship and take their marbles and go home. Mm-hmm. So the President's Working Group on Financial Markets has for decades been that smoothing operator. We've done similar things to the Chinese, so we might be critical of their high levels of intervention. Going back to 2008, we banned short selling. We didn't put anybody in jail, but we banned short selling on General Electric, a number of the financials, the same kinds of shenanigans that they've employed to bring about quote-unquote market stability. I think what most people don't understand is that if you can't short a stock and move to a neutral position, then you have to be willing to ride out long stretches of volatility. And it really leaves you with one choice: sell. So instead of shorting a stock, if you own the stock, just gets you to neutral. Mm-hmm. And so I think shorting in some respects has a bad rap in that regard. And by prohibiting short selling, you end up exacerbating a downtrend by forcing the decision of people to leave that stock altogether.
Mm-hmm. Yeah. Backfires, then essentially. Okay, so you mentioned the taking your marbles home as an expression you also used in your last podcast, and it seems as though that, to a certain extent, may have started to happen, notwithstanding today's strong market performance. But you mentioned that it seems as though money is coming out of both the treasuries and the equity markets at the same time, and certainly, we've seen during this bull run in stocks the exact opposite correlation: money in the equity market, out of bonds, and the other way around. When equity markets go down, bond market goes up, stock market, the treasury market goes up. But are you saying that seems to be breaking down a bit now, David?
Yeah, I would suggest that this is one of the indications that there is a greater level of concern. And again, going back to market sentiment having shifted, there's enough investors out there who say something just looks and feels different this time. And what is different this time in terms of the allocation shift is your normal allocation shift, if you're coming out of stocks, is to lower your risk and move to bonds. In this case, we have large amounts of money coming out of both stocks and bonds simultaneously, suggesting that people are more concerned with the system as a whole and that old phrase, will I get my money back versus what will I get on my money? Return of capital versus return on capital. I think people are much more concerned about the return of capital at all. Why is that? I mean, I don't know that we have anything on the immediate horizon that smacks of a Cyprus-style or Greek-style bail-in. But there is growing concern that something's not quite right.
Well, there certainly is a growing concern, and I believe it was Karl Rogoff in the Financial Times recently in which he suggested as much the same, essentially that the banks were not as good off as they would appear to be, and he sort of worries about people wanting to take their money out of the banks when things aren't going well, worried about people wanting to pull their money out, and so he's suggesting that we get rid of that second barbaric relic, and this was printed up in the Financial Times a week or so ago, that being cash. We got rid of the first one, gold, get it out of the system, and now, God forbid that people should have the right to take their own money and use it and spend it and live freely. They're suggesting we can't have a run on the banks. We cannot afford to do it. And so one of the excuses then for making only digital money, getting rid of cash, and this is, a pretty serious guy, Professor Rogoff, in the Financial Times. This is an establishment talking about the at least theoretical possibilities of getting rid of cash.
Yeah, well, and this is, I think, an extension of what Michael Woodford wrote about in his Interest in Prices, Foundations of Theory of Monetary Policy. He wrote this a couple of years ago, and it served as the justification for what Mr. Rogoff is arguing, which is basically moving us towards a cashless society. The reality is the guys who have PhDs, who are sort of running the monetary world, they're not willing to acknowledge that they've made any mistakes along the way. They kind of view themselves as wunderkinds. And so as boy wonders, as geniuses, the policies that they put in place are clearly bright, and they're the best, and they're perfect. Yeah. With that in mind, what we see happening is an anomaly. Why is velocity falling off the edge of a cliff? Why is the money and the liquidity that's been put into the system not churning through the system and creating economic activity? Rather than reappraise their ideas and their basic philosophy of monetary theory, monetary policy, they would like to say, you know what? We need to force the money out of the system, and we're going to force the money out of the system by putting a sell-by date on it. So that's what you're describing. Put a sell-by date on cash deposits in the bank, and it forces you to spend money. And you can't do that. You can't force money into the system and out of bank deposits if people have the option of putting money in the mattress, literal physical cash. So they would like to go to a cashless society rather than acknowledge that there might be some frailties in their theories of monetary policy.
So what is that going to mean? And suppose that goes through, what's it going to do to us and our freedom and our liberties?
These are very good questions. Freedoms, liberties. I mean, think about it. We have operated for hundreds of years, thousands of years, with the idea that we can transact business, and it's our business. It's nobody else's business. And so we've already given up by transacting the amount of business that we do on the internet. We've already given up the notion that somehow privacy is in any way relevant or important to us. So I think culturally, we are ripe for the idea that we just move to something that's more convenient. And all you need is a trumped-up case of money laundering or what have you, where, again, a Rogoff or a Woodford or somebody else comes out and says, we wouldn't have this problem, and we wouldn't, maybe it's the Chinese. Maybe the Chinese, there's a vast Chinese conspiracy to destroy the U.S. dollar through money printing or something. And the only way to solve it is to move towards this safer system. I think the people would sop it up. They'd love it. They'd love it. They'd feel, oh, that's going to make it all safe. It's going to make it all better. And after all, we knew it was the Chinese anyways. So they get a 2-for-1 system where they may move towards a cashless society on the one hand, benefit number one. Benefit number two, they have someone else to blame.
Well,
and I think that's where we're at.
You just used the word trumped up. And I just couldn't help but think about Donald Trump, and I think one of the villains, along with the Mexicans and people coming in from our southern border, are the Chinese, just exactly as you said. And I honestly, David, I've recently read the biography of Dietrich Bonhoeffer. You probably know the name, the great theologian that opposed Hitler and paid for it with his life.
It was required reading in our office last year.
It was required. Okay, so you know it very well. But getting the flavor for what life was like in Germany then, and how quick the people were to vent their anger or to accept Hitler because of their anger. And when I see Donald Trump, I don't mean to rain on anybody's parade that's listening to this that might like Donald Trump, but he concerns me a bit. We've got just a minute or so left. Could you comment, because you did make some comments about the political atmosphere that is brewing right now, both visibly both in the Democratic and the Republican parties. Would you care to just comment on that quickly?
Well, sure. When you look at Bernie Sanders and Donald Trump, you have two people who are outside of the mainstream and certainly not within the establishment, quote unquote, of either the Republican National Committee or the DNC. And, I think what it's suggesting is that the rank and file member, Democrat or Republican, is just simply sick of it. They can do the math. They can say, okay, so how does Hillary Clinton go from a zero net worth to well over $120 million? Last time I checked with my stockbroker, he can't do that for me, and it's not really even humanly possible in the time frames involved. If you're talking about a multi-generational process, maybe. So you've got Democrats who are saying, wait a minute, something's not quite right. Republicans who are saying, wait a minute, fiscally, Republicans don't do anything different than Democrats. They just spend money in large scales on other things. But it's really no different. Nobody's responsible. And so I think there is disaffection amongst the party, both parties. And so you have these two outliers.
All right, David, we're out of time, unfortunately. But I just tell people, go to McAlvany.com. You can hear David's comments on this and many, many more things.